Also, Navin Agarwal, the MD of Motilal Oswal Financial Services, will join in for some market talk. Let's thank our technical experts for joining us and get more market opinion now. Motilal Oswal has their annual India Ideation Conference that starts today. Navin Agarwal, the MD of Motilal Oswal Financial Services, joins us now from the sidelines of that conference. Navin, hi, good morning and thanks so much for joining us. You do interact with a lot of foreign investors. I wanted to ask you about what the mood is like amongst the FI community. We hear that a lot of India-dedicated funds like Amansa, Nalanda Capital, etc. have been quite active lately. Do you see more money coming in?
This year has been quite big in terms of the FI inflows already. We've seen almost $5 to $6 billion of foreign flows, I think more than offsetting the outflows that we saw in the last year. A lot of this is not just India buying but global emerging market buying, and you've seen most of the global emerging markets do actually far better than India. In fact, their up move or rally started well ahead of the Indian rally. I think for India, for foreign investors, for dedicated money to put in any serious additional flows, the outcome of election will be quite important. So while the views on that have changed in favor of the incumbents possibly coming back after all the geopolitical issues recently, the chances of serious dedicated money coming to India is more likely, in my view, only after the election results. And what you're likely to see before the election results is more inflows as a part of the overall GEM allocation increase, which has already continued into the current year and may possibly continue in the weeks or months to come also.
Okay, Naveen, good morning. Yes, I do take the point that there was quite a bit of catch up and we had underperformed before that. But has this market run made our market a bit vulnerable to post-elections allow? I mean, if the market does not get what it wants, anecdotally, those are buying opportunities, but just in the near term, is the market a bit vulnerable?
Yeah, see, we haven't seen corporate earnings coming through for a long time. Now, the strong earnings growth that we are forecasting is on the back of asset quality improvement in PSU banks and also certain private financials. So, even the next year when we are projecting a big earnings growth in FY20, a lot of that is being contributed by assumptions about asset quality improvement in the PSU banks and private financials. So, earnings growth is not really broad-based. It is concentrated in a few large companies within Nifty, and even within the mid-cap index, a few companies, the biggest 15-20 companies within the mid-cap space also. So unless the earnings growth broad bases, unless the overall earnings growth rates improve, the sustainability of any rally is always going to be questionable.
Naveen, good morning. So, on a broad strategy basis, given that we are very close to all-time highs, incrementally going forward, if this market is to go higher, then what's going to be the driving sector or the driving theme? Will it continue to be consumption, depending on however you play it? You might want to play it through banks or autos, etc., or actually staples. Or do you think the pendulum will kind of shift and swing towards cyclicals at some point?
So, I'll answer that in two parts. Firstly, we need earnings growth to come back. The projection of a 25% Nifty EPS growth in FY20 has to come through. So the assumption of the asset quality improvement has to come through. We are looking at private capex recovery in the next year. So that is something which will need to be closely watched out for, and will also be related to the political outcomes that we will see over the next 2 months time. As far as the private financials are concerned, private banks in particular, they are in a very solid position right now in terms of capital adequacy, in terms of the state of the rest of the financial sector, and their ability to take market share and grow strongly. So they'll continue to grow. Consumption continues to grow. A whole bunch of new interesting ideas which did not participate in the last 5 years can possibly come to the fore. So for instance, the telecom sector has completely got battered down, and any alignment between the top 3 players in terms of pricing in the course of the next 2-3 quarters could make that sector emerge as an interesting one. Utilities are not even talked about right now. Recently we had the CRC guidelines which was a boost to the profitability. If you have, we've already had the first rate cut. The rate cycle is benign for a large part of the developed world as well. So any continuity of rate cuts, over the next 3-4 quarters augur well generally for equities, but also particularly for utilities, which are not talked about, not discussed right now. As I said, private banks will continue to do quite well. Autos have had a massive retrenchment in the last 1 year's time. That too can come back. So I think we have a lot of levers to this market. What we have to closely watch out for is whether this 25% earnings growth and a possible 25, 50, 75 basis points rate cut, if both of those things come together, I think that's a heady cocktail for the markets. And I like to always quote this number. We are at 2.8% corporate profit to GDP. We are at 80% market cap to GDP. So we have to keep in context that the markets, we've had a very long dry spell of earnings, and on those beaten down earnings, the valuations of the market are in line with historical averages. So I think these are things that we have to keep in mind. This is good, fuel to fire, any rally in the markets, provided you have, political stability over the next couple of months' time.
Actually, I wanted to come to that point, because you said that serious India-dedicated funds will put in money only post-elections. But is this irrespective of which way the election verdict goes? I'm trying to ask you that, is India in any case in a growth path which is attracting foreign investors to put in money?
Absolutely. See, the structural growth of being one of the fastest growth economy, the whole demographic setup that we have, our corporate earnings a growth of 25% next year. So we are only talking near term. I mean, the structural allocation to India rising. We are at India's market cap currently is at 2.5% of the global market cap. And if you look at any other metrics, whether it is nominal GDP, then go up to the real GDP, go up to the population, the employed workforce, every metric is much higher than that 2.5% number. So we will see some narrowing of that gap over a period of time, and so structurally we will remain attractive for foreign investors. We are only talking about near term. We've had outflows of nearly $5 billion by foreign investors last year. We've had inflows of almost $6 billion in the current year as a part of the GEM allocation. But India specific allocation could be serious. We've seen foreigners put $15-20 billion decade back into India. I mean, those kind of flows will only happen if they see near-term corporate earnings recovery, political stability. I think those two things added together can potentially get you serious inflows also from the India-dedicated investors, in my view.
Okay, so let's say if all of those factors come together, then we might have indeed a heady second half, as you said. Thank you, Navin, for joining us on the show today. By the way, there's a very smart recovery on the mid-cap screen. You can't take away from that. In the morning when we opened out, that index was down almost 1.2%.